And a very good morning from us here at the K3 Hub, and welcome to this morning's CPD session. For those who haven't virtually met me before, my name is Marie Wadeston, and I'm a Managing Director here at Quantuma. And on behalf of our parent company, K3 Capital Group, I am responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Group. Since we launched in the spring of 2021, over 2,500 like-minded professionals from across the country have joined our network, through which they access a range of CPD and training sessions, which are not dissimilar to today's event, and also referral fees for certain types of work referred into our group. Today, we've got a 3-hour CPD session on accounting and compliance for OMBs. Before I introduce you to today's speaker, we do have a few pieces of housekeeping that I wouldn't mind just running through quickly. So as you may see, we are recording today's session. For those that wish to sort of look back, it will be housed on the K3 Hub and Quantuma websites next week. The Q&A function is open, so do feel free to, ask questions as we go along. Our preference is that you use the Q&A function rather than the chat to ask your questions, and just so that our speaker doesn't get too confused and is looking in two places for your questions. It's our intention to cover questions after each break. A question I get asked every week is about the slides. So we have already posted that into the chat, I can see, and we will post that periodically again throughout this morning's session, just for those who join a bit later. As I've already said, we are planning for a couple of short breaks this morning. They're likely to be on or approaching the hour. Okay, so on to today's session then in that case. So I'm very pleased to welcome back Val Stewart to the K3 Hub. So Val has presented for us before, for those that are regular joiners. Val has worked with accountancy practices for over 20 years, helping them to remain compliant. She lectures widely on auditing and assurance, and amongst other things is the author and co-author of a number of CCH technical guides and training manuals. Val's session today will broadly cover what OMBs producing compliant accounts under UK GAAP need to do to comply, common issues that arise in practice, triggers for additional disclosure, and changes in legislation. Just a couple of notes from me personally before I hand over to Val. So today is our final CPD session before the summer. We will be back in September, however, so no need to worry there. What we do have in the run up to summer is a series of shorter webinars starting next Friday, where we'll be running an EOT masterclass, which has had a staggering response, has been very, very popular. If anybody on today's webinar does want to join that and hasn't already registered, drop us a note in the chat and we can get that sorted for you. So all that remains for me to say in that case is I hope that you enjoy today's CPD session. Again, we'll be back with CPD structure sessions in September. And Val, over to you.
Thank you very much. Okay. Morning, everybody. I think before we sort of get going, I do apologise for the fact that I have a bit of a frog in my throat, so I might have to pause a few times for a sip of water as we're going on, but hopefully it won't be too bad. Okay, so accounting compliance for owner managed businesses. I've split this into 3 sections. So the first one's on the accounting side of things, dealing with the bits that Marie was talking about. I've put a very short session in on anti-money laundering, just because I think that is a very topical compliance issue for most businesses providing professional services. And then at the end of it, we've got something in terms of the legislative changes that are coming about with updates to companies' legislation. So, we'll run through all of those. As we said, if you have any questions as we go along, if you put them into the Q&A box, then what I'll do is that when we have the break, I'll just spend a couple of minutes looking through them, and then I'll spend a couple of minutes after the session just going through what my comments are on them. So without further ado, I'm going to start talking to you about the account side. And I think that obviously now we're coming up to a period where we're going to have a little bit more going on within the accounting side than we've had for a while, because, generally speaking, most professionals are going to be dealing, and I'm not dealing with IFRS directly, but most professionals are going to be dealing with accounts being prepared under either FRS 102 or FRS 105 for micro entities. So we've had a bit of a lull for a while in terms of this. The last substantive change we had was within the 2019 version of the standard. They did reissue or revise the standard in 2022, but that wasn't really as a result of any significant review. It was just to bring in some of the little minor changes that they make over the time period, largely the COVID related issues. But we're now coming up to a stage where we've got the exposure draft of changes to both FRS 101, which again, I'm not going to deal with that one directly because that is directly related to exemptions available to group members of companies preparing accounts under international financial reporting standards, and the equivalent exemptions and relaxations, so not having to do a cash flow statement, certain relaxations in terms of related party transactions and so on within the group situation where consolidated accounts are being prepared, is included within FRS 102 for people that are producing accounts under FRS 102. So the exposure draft then for FRS 102 also covers changes to FRS 105, and so we'll look at that one as we're going through. The initial consultation period closed at the end of April, so it closed on the 30th of April. So we're getting a little bit of an idea now in terms of what people's views are in terms of what's going to happen with the changes. But we won't know for another sort of like probably coming into the summer. We won't know what the response is going to be to that. So whether, I mean, from having a brief look at what the responses have been, I'm not sure that it's going to be enough of a change that they're going to want to issue another exposure draft. So open up another consultation period before the final version of the FRS is actually issued. But we'll know that as we go on within the summer. I think that before I sort of start talking to you about what the changes are here, I want to put it into context in terms of what it is. So although FRS 102 is our main reporting standard and is an application of the international financial reporting standards, they have now within IFRS, they have the IFRS for SMEs. So for small and medium-sized businesses, whereas we just have FRS 102 that applies to everyone that isn't either a micro entity or having to prepare accounts under IFRS. So, you know, sort of it's not just small and medium size, it can actually be within a large company if that large company doesn't have to, for other reasons, produce accounts under IFRS. So, you know, sort of that's where we are now. So obviously it's a one-stop shop. That is that based on the IFRS for SMEs largely. So what that is the IFRS for SMEs is a little bit like our old Frizzy was, it is a relaxation and an interpretation of how the full-blown IFRSs can be applied proportionately to smaller businesses, and smaller in the sort of like in inverted commas sense, because that can be small in terms of the control as well as small in terms of the size and the way that they do. So that is why, because it's already a relaxation of the IFRSs, that's why we don't have a big difference between, apart from disclosure, between what we've got within FRS 102 1A and FRS 102, because the whole principle behind it was that for all entities, because it was already a relaxation, so certain options weren't going to be available from a reporting perspective, some simplifications in terms of what it was that was being done, because it's already a relaxation, that they weren't going to relax it any further for particularly small entities. And the only move that we've got away from that is that with director shareholder loans within small companies, so if you've got those ones that are effectively non-commercial loans, which for larger companies will need to be, if they are non-commercial, if the interest rate's not commercial, then you'd need to discount them. So you'd have to be applying a discount factor that associated an appropriate interest rate. But what they've done is they've said that in the circumstances where that is a small business, so one that can do FRS 102 1A, then they are able to treat those at transaction price rather than having to discount them. So one very minor difference between what we've got for small micros are different, but what we've got for small as opposed to what we've got for larger entities in terms of the way that the disclosure is going to go. So this means when they were looking to do the update now for FRS 102, they waited until the IFRS for SMEs had been published, because what they were looking to do was, or the exposure draft for the IFRS for SMEs was going to be published, because in order for the FRC to determine what they wanted to put in to the exposure draft, they wanted to see what the response was to changes that had happened within the IFRSs internationally. So that was issued, the IFRS for SMEs was issued maybe 3 or 4 months before we actually got the exposure draft for FRS 102. There is, so what they do when they're looking at this is they look at changes, either new IFRSs or changes to IFRSs that have happened since the last time the standard was put together, as well as changes in legislation and other bits and pieces that might impact on it. And they look to subsume those in or determine how those are going to be treated. Now, for the first time, and maybe some of this is as a result of the Brexit issues, for the first time, the FRED that we've got now, the exposure draft that we've got for FRS 102 has moved away from what they've got with the IFRS for SMEs, and that is in respect of leasing, which we'll talk about in a minute. So there's 2 major IFRSs that needed to be addressed in terms of how they've applied those to the standards. So the first one is accounting requirements for revenue. So really for revenue from contracts with customers, what they've done is they've brought in, so that's within IFRS 15. There's a 5-step model. We'll talk about that one in a minute. And for both micro entities and for non-micro entities, they are, and for small ones as well, they're just expecting to put those provisions in their entirety. So again, we'll look at that in a minute. Really, the extent to which that will make a change on an entity's revenue recognition will depend on the form and content of its contracts with customers. And perhaps we'll talk about, again, we'll talk a little bit more about that later on, but part of what you might want to be encouraging your clients to do, what you might want to do yourselves in terms of what you do, is to make sure that you're looking at that 5-step model and making sure that it's clear in your relationship with your customer at what point the income becomes exclusively yours, if that makes sense. So at what point it's triggering you being able to recognize that as income. So it's an extension of what we used to have with UITF 40, if any of you can ever remember back that far. But you know, sort of like a good one really in terms of what it is that they do. The big thing, which is the difference, as I say, from what they've got within the IFRS for SMEs exposure draft, is that the lease accounting requirements will be based on the on-balance sheet model from IFRS 16 leases. So if any of you've done any IFRS accounts, you'll know, and we'll look a little bit about how that's going to impact in terms of what it is that they do. But, you know, sort of a lot of it, again, is going to be planning in terms of how you actually deal with this. So I can't see all of your faces, so I don't know what your age profile is in terms of what it is that you can do, but I'm old enough that I can remember when we first started to put finance leases onto the accounts, and it was maybe an easier exercise than we've got. So what this will do is it will actually change it both for finance leases and operating leases going forward, but we will have to put operating leases onto balance sheet as well, and we'll have a new classification on the balance sheet of right of use assets, which will reflect the leased assets that are actually included within the accounts. So it's been I suppose the provision is there to try and make sure that although we've always had within the accounts disclosures, we've always had to put in what the lease commitments are, and under FRS 102 and FRS 105, we've lately had to put in what the total lease commitments are rather than what they're committed to for the next 12 months, which is what we had under old UK GAAP. So we've been moving in the direction of making sure that it's a lot clearer within the financial statements what obligations they have. But I think that the view has been for a long time that they feel more comfortable with actually having that on balance sheet, because if it's included in the balance sheet, then it's better. It won't have an impact in terms of the net asset position on the balance sheet, but it will have an impact in terms of the net current position within the balance sheet, because obviously when you're recognizing the asset, you recognize the reflective liability, and that will be split between amounts falling due within 1 year and amounts falling due after more than 1 year. So you're going to be bringing an asset into your fixed assets, but you're going to be bringing a liability into your current liabilities. So it will show a deterioration potentially in the net current position in terms of what it is that we're doing. But you know, perhaps, as I say, it's been the move forward. It's worthwhile saying at this stage that although the income recognition aspects of the FRED will apply to FRS 105, so to the micro entities, that's the proposal. The the lease agreements won't, and it would have been counterintuitive for them to put that into micro entity accounts, because so we have a provision within there that we can't do the revaluations and all the rest of the bits. So it would have actually brought in some more complex accounting that would be contrary to what it is that they're looking to do with the micro entities. But of course, they will still need to disclose details of what their financial commitments are, which has always been the case in terms of what it is that they're doing. Before we go into a little bit more detail on some of these, just some more things that they're doing, there's a greater clarity now for small entities in the UK, applying Section 1A for small entities regarding those disclosures that need to be provided in order to give a true and fair view. Now, this one I think is an interesting one, because obviously when we had the changes to the Companies Act, which resulted in the FRISI being dispensed with a little bit earlier than I think the FRC had expected that to happen, what that did was it prescribed 13 disclosures that were required within small entity accounts, and that's what the law says, you have to have these in. But what they did was that, unlike with FRS 105, where with FRS 105 what they do is they say this is what the accounts should have in them, and if you want to put anything else in, then you can, but it's not required, because it shows a true and fair view if you have everything in that the legislation requires. What they did within for smaller entities when they brought FRS 102.1a in, the legislative change said these are the 13 things that need to go in, but the directors still have an obligation to consider whether those accounts show a true and fair view. So they have to consider whether additional disclosure is needed in order for the accounts to be able to show a true and fair view. So for them, what they did then was that when they put FRS 102.1a together, they obviously included all of the disclosures around what the legislation says needs to be included. But then what they did was they said, okay, there are certain things that we think that if they apply, then you should put these into the accounts in order for them to show a true and fair view, or you might want to put in, excuse me, sorry. So they said this is what you might want to put into the accounts in order for them to show a true and fair view, but it was discretionary. So what they were saying here was, for example, if you've got dividends, that you would, it would be useful for you to put the statement of changes in equity in, or any other movements within reserves, so that you can see what the link is between them. You didn't have to do that because the legislation didn't require it, but FRS 102 said, we think that if this applies, it should go in. Same with going concern and so on. If there's issues around going concern, then that would need to go in. What they've done is they've tweaked the wording a little bit on this in terms of what it is that they're doing. So what they're saying now is that you need to put this in. So if these are applicable, then they should go into the accounts, not you might want to think about whether they're needed for the accounts to show a true and fair view. So by default, what it's doing is it's making some disclosures that previously were optional for smaller entities, not optional anymore within what it is that they're proposing. So it's extending it beyond what the stand, what the legislation actually says, which is fair enough. And a lot of the accounting software, if you use one of the normal off-the-shelf accounting softwares, then most of them will actually recommend that anyway. So you'll see that those disclosures will go in automatically, even under the existing standard. But some people would have taken them out, and now what they're doing is they're putting a little bit more of a push on it and saying, yeah, actually, we're going to have to start putting this disclosure into the account. So that one's going to be interesting in terms of what it is that they've done. If you're interested in reading the standard, what they've done is they've revised section 2 on the concepts and pervasive principles. They've just updated that to reflect the IASB's conceptual framework for financial reporting, which was issued in 2018. So just before the previous update, but it's not a significant change in terms of what it is that we've got there, but you should be refreshing yourself on that. They brought a new section in, or are proposing a new section, which is section 2A, which is looking at fair value measurements, and that will replace the appendix to fair value measurements to section 2. And again, it's been updated to reflect the principles of IFRS 13 fair value measurements. So, sort of a little bit more structured guidance in terms of how you should go about making fair value measurements or looking at fair value of items within there. You may or may not remember that because within the IFRSs, there was quite a lot of movement around financial instruments around about the time that FRS 102 first came out. So we have had all the way along the option for us to be able to apply, when we're looking at financial instruments, to provide the recognition and measurement requirements of IAS 39 financial instruments, or to do the recognition under sections 11 and 12 of FRS 102. Now, from looking at lots of accounts that I do, I think in all of this time, I've only seen one set of accounts where they've actually opted to go for IAS 39 rather than what's within section 11 and 12. What they're looking to do is to remove the option for people to be able to apply IAS 39. So they've made some tweaks, or they're proposing some tweaks to paragraphs 11.2 and 12.2 in the FRS 102, which will allow people who permitting entities that are already applying the option to continue to do so in the meantime. So, sort of just to allow for a transition, I suppose, in terms of what it is that we're doing. Okay. I think I mentioned already that similar incremental improvements and clarifications are proposed for FRS 105. So we'll have that. I haven't said this bit yet, but to say to you that the proposed effective date for these amendments is accounting periods beginning on or after the 1st of January 2025. So that might seem like quite a way off, but it's not. We're already nearly, coming into the second half of May, so we're already nearly 5 months into 2023. And the thing that we have to remember in terms of this is that if it comes in for accounting periods commencing on or after the 1st of January 2025, that's going to be for our December 2025 period ends, but the comparative figures are going to be for our December 2024 period ends. So we're only 7 months off of the start of the period that will provide the comparatives. Now, in certain circumstances, we will have the choice within some things for us to be able to apply changes retrospectively, or to actually change them prospectively. So we'll be able to treat things as if they've gone into it from the day of implementation, so from the 1st of January 2025, or we'll be able to actually make the changes going back so that the comparatives are being changed as well. So it's important really that you start to think about some of these things now with entities that you're dealing with, because sort of the first well, we all know, or maybe you'd remember that when we actually started to get when FRS 102 first came in, and there was some quite significant changes, where we had to change the opening balances in the preceding year, as well as the preceding year, as well as the current year, that in actual fact, if you start to collect the information in the year that it's first going to impact, then that makes that whole transition a lot easier in terms of what it is that you're going to do. Okay, so I've just seen in terms of here, somebody said, can I have a copy of the presentation notes? That's in the question and answers. And can I just, you might have come in a little bit late, but can I point you through that? If you open up the chat box, there's a download there for the slides. If anybody hasn't seen that already, then it's there. I think they'll carry on posting it in a little bit later on. Okay, so that's when it is. So it's a proposed implementation date at the moment. If they decide that they need to reissue an exposure draft as a result of the feedback that they've had, then there is a possibility that that will be pushed forward. But I think that because it's 6 years since we've had a significant change, I think that they're probably looking very much towards having it being introduced for accounting periods commencing on or after the 1st of January 2025. Okay. So a few things, proposed changes in more detail, some extension of the reporting exemptions where information is included in consolidated accounts. That's a reasonable one. They will, for the leasing arrangements in terms of what it is that they're doing, then there will be some relaxations of the existing arrangements. So they can apply the provisions to the state now rather than carry it back, which is what I've already said to you, but of course that's a choice. And so, I can't decide what it is that I think in terms of those. I think that for existing finance leases, you might want to leave them, sort of like as is, not make any changes in terms of what it is you're doing. But for operating leases that you're having to put on balance sheet, it might be simpler for you to say, look, we're just going to do that now, rather than do it retrospectively. But of course, the issue that you have then will be that the impact on the balance sheet will be much more obvious because your comparatives won't show the change. So you'll have something that, so you'll have to have disclosure that is explaining what the changes are and how you've actually applied that. So there is an element of me that thinks that if you're going to be doing all of that, then maybe it's better for you to do it retrospectively, so that you've got something, sort of being reflected right from the beginning of the lease term. But sort of, I think that's going to be discussions that you're going to have with your clients, and sort of, and think amongst yourselves in terms of what it is that you want to do. Where you've recognised that there was a lease, so where you've already got it in as a finance lease and there's no change in terms of what you need to do, you have to be consistent. So in terms of whether you do it going forward or going backwards, you can't say, oh well, for these leases we're going to do it retrospectively, but for these ones we're going to do it just going forward. You need to have a consistent treatment in terms of what it is that you do, and you'll need to disclose the transitional provisions that you've applied in terms of what it is that you do. Just in summary, in terms of what it is that we'll expect, all leases will be on balance sheet. So all leases that clients have will be on balance sheet, except ones that have less than 12 months to run, or are for less than 12 months when they're new leases that have been brought in, or ones that are of low value. So I think that one's quite interesting because, sort of like it's individual leases that are of low value. So if you've got a business, for example, that what they do is they do what would be an operating lease for some of their computer equipment, so for photocopiers, for those sorts of things in terms of what it is that they do, and they do those individually, then if they're low value, and that will be something for the company themselves to do, and obviously they would have to disclose that within their accounting policy, what the value of low value was to them in terms of what it was that they were doing. So it might be that if what you're doing is you just got a computer and the computer's £1,000 and you've got that on a 2-year lease agreement, then you wouldn't do that because you'd say £1,000 is low value in terms of what it is that we do. But if what you've got is you've got people that have got a, say they do an upgrade to all of their IT at the same time, and so they've got one leasing agreement that actually deals with a number of different items, I think my take would be that it is on the value of the lease as opposed to the value of the individual things that are making up that lease. So maybe there'll be a bit more clarification as things are going forward, but you know, sort of, but I think that by and large, you can guarantee that if they've got a formal property lease, then that would have to go on balance sheet, and probably cars are going to be the other one that's going to be a major issues if they get those on contract hire or whatever. Then those will end up coming on balance sheet as well. The assets are capitalised as right of use assets, which I've already talked about, so a separate category outside of property, plant and equipment in terms of what normally shown separately on the face of the balance sheet. The lease liability then is determined at the date of initial application. The lessee measures the lease liability at the present value of the remaining lease payments, which is discounted using the lessee's incremental borrowing rate or the lessee's attainable borrowing rate at the date of initial application. So in terms of what it is that we're doing here, for finance leases, that's always what we've done, but we've known what the rate of interest is in terms of how we put that together. So we've actually, you know, sort of we know what the total payments are going to be, and we can take that interest element out in terms of what it is that we're doing. For operating leases, I suppose it makes sense that if what you've got is you've got a 10-year property lease, for example, and you're paying £20,000 a year in terms of what it is that you're doing over that 10-year period. So you're paying 200,000 in total over the period of the lease. We know we've just coming out now of a very low inflationary situation, but we do know that as we're going forward in terms of what it is that we're doing, we do know that what £20,000 in 10 years' time at the end of the lease in real terms is going to be worth less, or is going to cost us less than the £20,000 that we're paying now. And so that's why we do that NPV thing on there, is that we actually look at it and we look at what the interest proportion, when somebody's actually setting that, you know, they're taking into consideration the time value of money when they're deciding how much it is that they're happy to accept annually on the lease. They're not putting it up each year. So as a result of that, we have to discount it. But of course, when we're doing a finance lease, as they are at the moment, we know what the interest rate is. Whereas if we're doing an operating lease, we don't. So we have to look at what the incremental borrowing rate is of the lessee, or their obtainable borrowing rate at the date of the initial application. So when they did it. Now, what they have done, this is one of their simplifications, is they've said that if the lessee's incremental borrowing rate or their obtainable borrowing rate at the date of initial application can't be readily determined. So if they had an equivalent finance lease that they were entering into the time, or other borrowings that they were doing, then you might be able to say, yes, we can do that. But if you can't determine what it is, then you can use the gilt rate at the date of initial application. And at the moment, that's around 3.5%. So, you know, sort of actually probably less than a lot of them would be charging. So that's what it is that we can do for applying the discounting. People, when they do this initially, sometimes they're sort of starting to talk about it and thinking, oh gosh, you know, sort of like, how are we going to calculate this? How are we going to do all of this? I don't work in the profession, so I don't have clients, if that makes sense. All of my clients are firms of accountants, but I do know that within Excel, there is a function that allows you to do the NPV calculations if you want to. So if you've got a whiz within your office that can look at that, it's probably quite straightforward. But I would also imagine that as we come closer and closer to the implementation date, there's going to be things that will probably be quite freely available that will be fixes for people to be able to do it. Okay. There's also provisions or specific provisions for lessors and for sale and buyback arrangements, but we'll we'll talk about those ones a little bit later when we got the clarity of the full-blown standard, I think. So going into a little bit more changes there, I think that when they first apply the periodic review amendments, you can also apply the revised revenue from contracts retrospectively with the cumulative effect of initially applying the section recognised as an adjustment to the opening balance of each affected component of equity at the date of initial application. So we can actually, for the revenue recognition as well, if that has a if that changes significantly the point at which you'd be recognising it, then you can make the change retrospectively, but you don't have to. It is going to be an option for you to do it. A few other bits in terms of changes that we've got to FRS 1021A then, which I think for a lot of you is going to be the standard that you come across more often. So a small entity then is going to have to provide disclosures set out in the 3.8A relating to the use of the going concern basis. Now, this is going to be across the board in terms of what it is that we do. Then what we've got for going concern at the moment is a little bit more optional, whereas I think now it's going to be, you know, sort of like required for everything. So what 3.8A says, the revised one, is when an entity prepares financial statements on a going concern basis, it should disclose that fact together with confirmation that is considered information about the future as set out in paragraph 3.8. And then it should also disclose, in accordance with paragraph 8.6, any significant judgments made in assessing the entity's ability to continue as a going concern. So I think that the issue that we've got here is that in the past, we wouldn't necessarily have going concern disclosure within the accounts if there weren't any issues, because it was one of those sort of deemed policies, if that makes sense, that the accounts would be drawn up on a going concern basis unless we told them. Now all sets of accounts are going to have that statement in them to say that the going concern basis has been applied, and also that the directors have considered information about the future, so that they've considered a period of 12 months from the date of approval of the financial statements when considering their assessment as to whether it's appropriate to use a going concern basis. So that will be in all sets of accounts, small or non-small, where you've got going concern issues or where you haven't got going concern issues. And obviously where there's judgments that have been made, so where there might be a loss-making entity or one that's got net current liabilities and so on, where the directors have had to make some judgments in terms of why they believe that the entity is going to be a going concern going forward, then you'd still have to have that related disclosure in terms of the steps that they were taking and the reason, which might be parental guarantees or directors' guarantees, or, you know, whatever it is that that is making them determine that the going concern basis is still going to be appropriate. I think it's worthwhile sort of, I've just seen one of the questions. Simon, I'm sorry, yes, it goes in as a corresponding liability. So it'd be the same as we've got with the finance leases, except for the fact that with finance leases, we know what the interest element is in terms of what it is that we do. So you'll have the operating lease on balance sheet as a right of use asset, and then you'll have it as a liability, which will be split between amounts falling due within 1 year and amounts falling due after more than 1 year, which was a bit that I was saying earlier on, that will mean that there could be an impact in terms of the net current position within the accounts in terms of what it is that you're doing with the operating leases. And I think, just as an aside, in terms of what it is that you've got there, if you know that that's going to be, if you've got significant operating leases that are going to go on balance sheets, and you've got entities that have borrowings with covenants that are actually around the working capital within the entity, then it's worthwhile getting them to go back and to talk to the bank or whoever the financial institution is to make sure that just by making this accounting change that doesn't impact at all in terms of what their obligations have been in the past, that accounting change won't mean that they're going to be failing on covenants that they've got. So, you know, sort of like quite quite an important one in terms of what it is that you're doing. Okay. Obviously, what they've done is, because they're now bringing in this new category of right of use assets, then that we'd have to have the same sort of disclosure for them as we do for other fixed assets, for property, plant and equipment. So we will have a balance at the beginning of the year, additions and disposals during the year, balance at the end of the year, and then the same for the depreciation that's being charged in terms of those assets to write them down, so that at the end of the day we've got, you know, sort of like nil value in fixed assets and nil liability once we get to the end of the lease term. Where they've got where a small entity that has leases will have to do, or is a lessee, will have to provide a general description of its significant leasing arrangements, and if necessary to enable the users to understand additional qualitative and quantitative information. Okay, so that's what we've got within within the full-blown FRS, that they're just saying, look, we just have to have this for leases. So we've got a little bit more information, and I've done what it says within 20.85. I would point out to this, I don't think I put it onto these slides, but this is sort of like saying what it says within there, what you've got to do. So the future cash flows, restrictions or covenants imposed by lessees and sale and leaseback transactions, those are the bits that would need to be disclosed within here. If you go into the full-blown FRS, there's an element to me that thinks, I'm not telling you all that you've got to go back and read it all, but I do think that it's not a bad idea for you to make sure that you've familiarised yourself in terms of the contents of what's within FRS 102. And it is eminently more readable than some of the predecessor standards were. So we have FRS 102.1a. I don't think FRS 102.1a is actually as clear sometimes as it should be. And that's because it was almost like an afterthought, because they thought that for a while we were still going to have the frizzy. So we'd have had the frizzy and we had FRS 102 that would just be for everything that wasn't small. So what they've done is, rather than having it small and build up, they've got large and build down. But what they do within the main standards, and remembering that apart from that one exception that I gave you before, the accounting treatment is the same irrespective of the size of the entity. It's just the disclosure that's different. So if you go into the full-blown individual sections, rather than looking at 102.1a in terms of what's there, what they do within the individual sections is perhaps giving a little bit more clarification on the accounting treatment. But also, when you look at the disclosure requirements, they have either an asterisk or a cross by the side of the bits that apply to small companies. So sometimes looking at the context of what larger companies have to do and thinking about what can be left out for smaller companies can be easier than thinking about it in the context of what you have to put in for small companies. So I would encourage all of you, it's free to download FRS 102. And just familiarise yourself. If you're thinking, well, I'm not sure how this is going to work, then just look at what you've got within there and what you'd have to have for a larger one and what can be left out in terms of the small ones. If they've got short-term leases, leases of low value assets and variable lease payments, then again, we have to put those disclosures within the notes. And this one, it comes in as like a little bracket, but that's the cross that's in there. I don't know why it doesn't copy through. Then this is what we're saying. So you can say within here, I mean, all of this disclosure really is required within here. So depreciation charge, expense relating to short-term lease accounted for, not including expense relating to leases with lease terms of 1 month or less, expense relating to leases of low value accounted for, expense recognised directly in the P&L relating to additions to right of use assets and the carrying amount of right of use assets at the end of the reporting period. So, you know, sort of like quite a lot of disclosure. And then what they need to do here is they need to set out. So if it's short term or leases of low value, then the same as we've got before, that you split out the amount that's going to be paid not later than 1 year, later than 1 year and not later than 5. and later than 5 years, in terms of what it is that you've got for the disclosure there, which, you know, sort of, again, depending on the significance and the materiality within entities, even some quite substantial ones within smaller companies might not be deemed to be material. Again, they'll be able to put right of use assets in at impaired cost or at revalued amounts. And so again, they need to have the disclosures of that if they decide to do it. We have some further recognition in terms of what we've got to do on disclosures relating to provisions and contingencies within the accounts. So just some tweaks and changes in terms of what it is that we do there. And I think that all that they're doing is they're just sort of like clarifying what the position is. I don't think the definition of what we've got as a provision is going to change significantly, but we just need to make sure that we, you know, that we recognise that this definition here, that a liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So it's just a slight tweak in terms of what the disclosure, the thing is. We then have revenue recognition. So I mentioned earlier on in terms of this one that we have the 5-step model, and this is what the 5-step model says in terms of what it is that they're doing. So what you have to do, I think, and it's largely going to be about, so it's not going to relate to somebody who walks into a shop and buys something, you know, so where you've got that, you know exactly what the point of sale is going to be in terms of what it is that you're doing. But I think that anybody that's providing any form of service or what they do includes any form of service, then effectively what they're saying is, you know, there's always been some, it's wrong to say doubt, but there's always been some tweak or some issues in terms of what it is that we're doing. What they're doing now is they're just making that a little bit more clear cut. And I think it's quite good. So the 5-step model there is that you identify the contracts with customers. So you identify where your terms are going to be. And so for people like accountants, for example, that's potentially going to be set out in your letter of engagement to your clients. So within there, you're specifying, you know, this is the point at which, so we start to get value in terms of what it is that we're doing. You identify the promises in the contract, so what it is that you're looking to do. So within your, again, if that's within your letter of engagement, that you look at it and you say, well, these are the services that we're providing. So these are the promises that we make, that we're going to be doing your VAT returns, we're going to be doing your payroll, we're going to be doing the confirmation statements for you, your annual accounts, your CT 600, you know, whatever else it is that you're providing as services. You've got those promises within the contract. Then you determine the transaction price. So you're looking at what the value is that's going to be associated to each of those constituent parts of the service that's being provided. So allocate that to the promises in the contract. And then you recognise the revenue when or as the entity satisfies the promise. The issue that you'd have to have in terms of what it is that you're doing now, if you were doing it for a firm of accountants, for example, is that it's how you look at those promises and how you actually describe those to the client, so they know what their liability is going to be. And I think that this is quite a good one in terms of what it is. So if I'm doing the annual accounts for a company, and you know, sort of my price for that is whatever it's going to be, so say it's £5,000 that I'm doing for that. At what point does that £5,000 trigger? Is it when I've completed the accounts, or is it at an earlier stage? You know, so do I have to break down my promises in the contract, not just the final figure that's there, but also to take into consideration some of the work that's done to lead me up to the point at which I'm going to be delivering the final promise. A little bit like we have for construction, for example, you know, sort of where you'd have those valuations that are done periodically that will say to you, okay, you know, if you walked away from it now, or something happened that meant that it couldn't be completed, I'm still entitled to a proportion of the work that's actually been done. So I think that it's going to require accountants, whoever, and maybe for you to be talking to some of your clients as well, to say, look, you know, how do you set this out? What is it that you want to do, so that you can actually have a clear vision, and we know the points at which income should be recognised, and we can start to collect the information so that it's not a laborious exercise at the end of the accounting period. So there has been some discussion that maybe this is a bit too complicated for micro entities, but at the moment, we have that within the micro entity as well. And again, the entity would have to provide disclosures relating to its promises and contracts with customers. So, you know, sort of your accounting policy on income recognition would have to set out clearly the stages, the points at which income was recognised. So this is, you know, sort of this is the disclosure that's actually required within the accounts. So when they typically satisfy the promises, so whether that's going to be on shipment, on delivery as the services are rendered, or on completion of the service, in terms of what they're doing, significant payment terms. So when it's typically due, whether the contract includes the financing transaction, and whether the consideration amount is variable in terms of what they do, and then the nature of goods and services that the entity has promised to transfer, highlighting promises to arrange for another party to transfer goods or services if they're acting as an agent, and then the types of warranties and related obligations if those apply. So when we come along to look at some of the common problems, I think that regulators are already picking up on the fact that they think that there needs to be a clearer view of, you know, a turnover policy in terms of what's there, and we're just going to see some more changes in terms of what it is that we're doing here. A couple of changes to related party transactions then. So they're just adding into their commitments to do something if a particular event occurs or does not occur in the future. So some form of financial commitment, that's actually coming in as being a disclosable related party transaction. And then under FRS 105, income recognition, as with 102, operating leases remain off balance sheet with disclosure on commitments. So, you know, sort of we'll just have that, which I think I'd already explained to you. I think just before we're coming up to a break in terms of where we are, which will give us sort of like a natural break in terms of this one, I've put in here what the ICAEW response is. So what they've put, just looking in terms of what they are, and it seems to be reflective of what most of the responses that I've looked at to the discussions have been, and that they're broadly supportive. So the broadly supportive is that I think that, you know, sort of I did wonder what they were going to do, and there was an element of me that wondered if there was going to be something that would say that maybe lease accounting would be something that would go on balance sheet for the non-FRS 102.1a, having already made one change. But I think that there is still a really big drive in terms of ensuring that accounts are going to be transparent, and we'll be talking about that one a little bit later on when it comes to changes in company law that are going to come in. Not sure exactly what the timescale is, but that will be coming in the foreseeable future. Then I think that with that transparency side, then I think that there will be, however they might simplify it a little bit further, there will be still that requirement for leases to be shown on balance sheet. Just because I think that, you know, sort of when it's hid as a financial commitment somewhere in the notes to the accounts, there was part of me that thought maybe it would have been sensible for them to have looked to say, well, you could actually bring that disclosure, so the financial commitments, onto the bottom of the balance sheet if you wanted to, so you could make it a more prominent disclosure rather than allowing people to put it wherever they wanted to within the accounts. But I think that there is just too much of a move towards wanting to have those on balance sheet that it's likely to happen. The Institute said that as far as they were concerned, lease accounting was good, but it's not quite right. So they're looking for perhaps further simplifications in terms of what they've done. They noted that almost all of IFRS 16 was included, and that the that the simplification was mainly on that, the interest rates allowable. So that's the thing where I said to you that they can use the gilt rate if they can't actually find an interest rate, which just it seems to me to be very sensible in terms of what it is that they're doing. But, you know, there might be some more thought, so there might be some further simplifications in terms of what they're looking to do there, but I doubt very much if that will go beyond saying, you know, sort of that it will go to the extent of saying that you don't need to put them on. Okay. And I mentioned this one before, that they also question whether the income recognition model was too complicated for micro entities. I'm not sure that it is, but I think that maybe it's even best practice, because it can, you know, sort of it can help businesses to avoid disputes if they've got a clearer policy, so that it's very clear to people at what point a liability becomes crystallizes. But, you know, sort of that's just the way that it is. So just before we break, I just wanted to sort of like put this one out into the equation in terms of what it is that I think you need to do now. I think that you need to consider entities with leases and the impact that this will have. So I think that part of what you should be doing when you're dealing with clients, those of you that are working in the directly in the profession, those of you that do your own, then you should be thinking about the leases that you've got and collecting the same information for them. But, you know, sort of, I think you should be looking at those and saying, these are the ones, this is what it is that we're looking to do. I think you should start a register of all leases for clients, or again, tell them that they need to start doing it for you, so that you can actually start to collect that information, so that you've got information about who they're with, what they're for, the start and end dates of the leases, the payments that they're making, any special circumstances, so things like break clauses, and where appropriate, the interest rates that they've got. So this will also be for finance leases, and if you've got those, then that can help you. If it's not going to be the gilt rate that you're applying, it can help you to determine what the actual effective interest rate would be for the client. So it's quite simple, just do it in an Excel spreadsheet or whatever. But again, saying that if you start to prepare for that now, it's going to make it a lot simpler for you to be able to apply this a little bit later, a little bit later down the line, if you're doing it. If they've got contracts, so if they provide any form of service contracts, or if there's any stages for the income recognition side of things, then think about what those measures are, think about what their policies are, look at what their terms and conditions say, you know, how it is that they do them, so that you can actually sort out whether there's going to be any changes in terms of how income is recognised within the accounts, and you can suggest any tweaks that they might want to do. And then lastly, and we'll perhaps come back to this one after the break, consider whether all entities that can are applying FRS 105, because obviously there's going to become a bigger distinction in terms of what it is that we're doing for 105 and what we're doing for 102 1A. I'm a couple of minutes later than I'd like to have been for the break, but it's 10 o'clock now. So if we can take a break for 10 minutes, what I'll do is I'll turn my my mic and my camera off, and I'll turn it back on again, you know, sort of when I'm ready to start. So I'll see you all in a few minutes, and I'll come back to that last bit when we restart. Okay, welcome back, everybody. Before, I just said I was going to come back to something at the bottom of that slide. Somebody has asked me a question. I'll just read it out to you. It says, so it's Mark says, revenue recognition, I assume it's only referring to the point at which an invoice is raised, or does it also include work in progress? For accountants, our contract states time is accumulated, but we will only bill this before a job is finished if the client leaves. Should this also be included in the note, as WIP is included in turnover in the accounts? And yes, it should. So, you know, and I think that it needs to be, as I say, you need to be going back and making sure that in terms of your contracts or your agreements, that it's very clear the point at which you become entitled to money from what it is that you're doing. So I think it is just clarifying or solidifying what it is that we've got within the standard. So any more questions that people have, then if you just put them into the Q&As, and I'll deal with them when we come to the next break. So before the break, I said to you that I'll come back on, because I think it's worthwhile doing this in terms of entities that are applying FRS 105. I don't know how many of you actually do routinely use FRS 105. I know that for a lot of accountants, it's been something where they haven't been too comfortable with it because they don't feel that the accounts show a true and fair view. But if you picked up, I said to you a little bit earlier on, that the legislation is quite specific on this. And it says that for micro entities, this is the disclosure that's required. And if that's included within the accounts, then as far as they're concerned, those accounts show a true and fair view, however it is that they've been put together. Now, I know, you know, from my perspective, I'd look and I'd think, actually, they don't show a true and fair view in the way that I was taught a true and fair view was when I was training. So I can understand how people sometimes would be a bit nervous about them. But there's two things we have to remember. The first one is that if they have that disclosure in, they are complying, so they are true and fair. And the second one is, it's not necessarily our choice as accountants, it's the client's choice, because it's what it is that they want to do. They are simpler. They do provide in them less information going onto the public record than you get within filleted accounts. And when we talk about some changes that are coming about within Companies House, it might make you look within the company legislation, it might make you want to look a little bit more closely at these. When the regulations first came in 2013, the statement that was issued by the government in terms of looking at the impact that this would have was that more than 50% of the private companies that were on the register actually qualified as micro entities. So it's a huge proportion. And of course, unless you're working in one of the really big firms of accountants, then that proportion, the proportion of your clients that qualify as micro entities is probably going to be significantly north of that 50%, because you'll have proportionately more of the smaller entities that aren't dealt with, generally speaking, by the large firms of accountants. So I don't know what the actual, whether there's any statistics. I've not seen them, I've not found them in terms of what the take up has been, but I would imagine that it's less, significantly less than the 50%. And certainly when I go around and I talk to firms of accountants, I get a lot of them where routinely they won't look at FRS 105. But as we're getting things that are becoming more complex into FRS 102.1a, like the leases, for example, if you've got entities where, you know, sort of where they are applying FRS 102.1a, but they could do FRS 105, but they've got leases, then you might want to consider whether you talk to them about moving over to FRS 105. I think that there are certain circumstances where you might not want to. So if you've got an entity that's growing and is looking to grow, and so thinks that they're not always going to be able to apply 105, then, you know, maybe you don't, because you think, well, actually it's better for us, or it's more complicated to deal with the transition if they're moving from 105 through to FRS 102, then it's more of an issue. But you know, sort of, I think it should be a question that you're asking yourselves. And remember that also, although you can't do a set of the accounting treatment's going to be slightly different, so you've got the simplifications in terms of what it is that you do, you can't produce a set of statutory accounts under 102.1a, excuse me, and then file 105. Sorry. My apologies. You can't do that in terms of what it is that you're doing. But what you can do is you can actually put more detailed information into the management information that you've got at the end of the accounts, if you feel that that's going to be useful to the users of the financial statements, and also to the banks, if, you know, sort of they're looking and thinking, actually, we don't like 105 because it doesn't have some of the things that we would routinely see in a set of accounts. You could put that into those information into the management information that doesn't then get filed with the statutory accounts. So, you know, it's fine in terms of what it is that you do. So I would encourage all of you, knowing that these changes are going to come back, come about to look at where you are with 105 and what you normally produce for your clients, and perhaps have that discussion with them in terms of, you know, these are changes that are coming about, these are things that are going to happen. And so it might be the time now for us to think about whether 105 is appropriate rather than 102.1a. You may well notice that we haven't had any changes in the financial limits for 105 since 2013. So that's 10 years in terms of what it is. So potentially that will actually take, you know, it might be slightly less than 50% of companies that will qualify now, because inflationary issues would actually have pushed them above the thresholds in terms of what it is that they're doing. But I think I've seen some little niggles that are suggesting that they might, when some of these changes are coming through, that we might actually see an increase in the limits for micro entities, although I haven't seen anything yet that suggested that they're going to change the limits for small companies as well, which obviously has an impact on the audit requirements too. Okay, so without further ado then, I'm going to move into narrative accounting. So the narrative disclosure within the accounts, and just a quick run through in terms of some of the things that you need to take into consideration with this area. So I'm going to start off looking at the Companies Act size thresholds, just as a reminder in terms of what it is that we've got here. So still the same for a while. We've got turnover 10.2. Sorry, that balance sheet total, I should have changed that. It's 5.1. So it's always less than just half of that. 10.2, 5.1. Average number of staff, 50. For small, medium, we don't do medium-sized company accounts anymore. But when it comes to some of the narrative disclosure, there are certain disclosures that come in for entities where they're considered to be large. So the medium-sized criteria then is relevant, because what we're doing is we're looking at it and we're saying, okay, if it's non-medium, then it's large. And so these additional disclosures actually trickle in. So that's turnover of 36 million. It's half of that, the balance sheet total of 18 million, an average number of staff of 250. To qualify in terms of these criteria, we have that 2-year smoothing rule. So unless it's a new company, then they have to have gone above the limits for 2 consecutive years in order for them to not be small or not be medium in terms of the way that they are. And then once they're into one of those categories, they have to go above it or below it, depending on what it is that they're looking to do, for 2 consecutive years in order for them to actually qualify as the smaller entity or the larger entity in terms of what it is that they're doing. So it gives them that smoothing exercise. It's 2 out of 3 of the criteria. Just a couple of things that people still get wrong in terms of what they're doing. So hopefully none of you will. So, but just to remind you that the balance sheet total is not the net assets of the business; it is the gross assets of the business. So it's you know, even though we call it balance sheet total, it is the gross assets. So it's the total of your fixed and current assets. So obviously for some entities, this might have an impact when they bring the right of use assets in, because you won't be reducing that by any liabilities. But if you're bringing those in, if you're bringing in an operating lease in respect of a property, then that might be quite a significant increase in the net assets that are, sorry, the gross assets that you've got within the business. So it might trigger it. And then the average number of staff, again, this changed a while back, but I still find some people that are that get confused with this. And the average number of staff, it used to be that what you did was, if you had part-time staff, you'd actually treat them as being, you know, sort of half a person or a third of a person when you were doing it. The change that came about several years ago was that it said that the average number of staff should be the average number of people that you've got on the payroll through the course of the year. So if you do a monthly payroll, you'd look at the number of people you've got on the payroll at the end of each month, add those together, divide them by 12, and that gives you the average number of employees. So with the increasing number of people working part-time, that's I'm seeing now that within companies that's actually becoming a larger amount, and where it used to be quite often, or in most cases, that it would be the financial triggers that triggered you across one of the thresholds. Now, and particularly within industries where they have a lot of part-time staff, then the average number of employees is something you need to watch out for, to make sure that they're not triggering themselves over the threshold. So just a reminder in terms of what it is that we've got there, for how that one works when we're coming into the disclosure. Okay. Also a reminder that we have these other exemptions. So for small companies, they don't apply to a company that was at any time within the financial year. So a public company, a company that's authorised for financial services measures, and or a member of an ineligible group. The public company in this context is one that is a PLC, including ones that I call vanity PLCs. So ones that don't have any intention of listing, but want to be a PLC because they think that that makes them look better in terms of what it is that they're doing. The ineligible group one is an interesting one. And again, I think sometimes people miss this one in terms of what it is that they're doing. So a group is ineligible if any of its members is a traded company, so it's listed, a body corporate other than a company whose shares are admitted to trading on a UK regulated market, and then you've got the financial services stuff, you know, the e-issuer and all the rest of the bits and pieces. What they did within there is that they removed, when they changed it, it used to say a PLC. So if you had that vanity PLC as part of a group, and the group was small from a financial perspective, then they would still not be able to, none of the members of the group could actually be treated as being small. So they'd all need to have audits, they need to do, you know, sort of their, and they need to do the full disclosure that was required in a non-small company set of accounts. But they've changed that to being a traded company, or ones whose shares are admitted and traded on a UK regulated market. So as a result of that, if you've got a group that contains a PLC that is a vanity PLC, that company will always have to have an audit. But for the other members of the group, provided that they are small, and provided that the group meets the financial criteria of being small, the other members of the group would actually still be able to treat themselves as being small. I hope that makes sense to you in terms of what it is, but it is something that people sometimes miss in terms of what it is that they're doing. Before we look at some of the issues around the disclosures, I put this little one in as a bit of a summary in terms of what people have to, what companies have to have within their accounts. So I didn't put micro onto there because, you know, sort of micro entities don't have to have a director's report, so they don't have any requirement for narrative reporting. Small companies have to have just the director's report with the relevant disclosure within there. Medium-sized companies have to have the director's report and the strategic report in terms of what they're doing. And then large companies, so ones that are above the medium-sized threshold, have to have a director's report, a strategic report, the Section 172 statement, which we'll talk about in a minute, directors' policy relationships regarding their relationships with certain entities, and the climate change and carbon emissions. There are some other disclosures that are required for ones that are larger than large, so where they put bigger financial limits onto them, but I've not dealt with that in terms of the disclosure that we've got here. Okay, so somebody said to here, if a subsidiary is a vanity PLC, but the parent is still a small company, not a PLC, does the parent need to be audited? It's the group. Okay, so if the group meets the small criteria, then with the vanity PLC within it, then the Vanity PLC would need to be audited, but none of the rest of the group would need to be. Hope that makes sense to you. So, and that's the way that that one goes. I wanted then just to talk to you a little bit in terms of what the content of the strategic report in particular needs to be. I think that within the director's report, it's quite factual information. Within the strategic report, it's a lot more. So the idea behind the strategic report's a little bit like we have for the trustees report within a charity, is it's going to provide more information, so to inform the members of the company and help them to assess how the directors have performed their duty under section 172, which is the duty to promote the success of the company. Obviously, if it's a medium-sized company, it doesn't have to have that specific comment on section 172. If it's a larger company, then it does. It has to include within it a fair review of the company's business and a description of the principal risks and uncertainty facing the company. Then we've got sort of certain other provisions that come in, non-financial and sustainability information that is contained within section 414 CZA in terms of what it is that we've got within the Companies Act. I suppose before I actually go a little bit further in terms of what it is that I need to do, what I want to do is, some of you, I'm sure, are going to be people that are working in industry, and so you're going to be preparing the strategic reports in terms of what it is that you've got for the business. Some of you are accountants in practice, and so what's going to happen in terms of those is that you're going to be requiring the company to prepare the strategic report. And I think that without being rude, that sometimes what we do is we abdicate the responsibility of that to the client, because it is the client's strategic report, like it's the client's director's report. But sometimes we're going to be dealing with companies that don't have a degree of sophistication, so they need a little bit more hand-holding in terms of what it is that we want to do. And of course, if compulsorily they need to have the strategic report, that in itself is going to be associated with an entity that's having an audit. And we need to remember that if we look at the contents of the audit report within it has two references towards the narrative reporting. We make a statement to say that there is nothing within the narrative reporting that contradicts what there is within the rest of the financial statements. So that can be as basic as them saying that they've made a profit in the strategic report, where in actual fact they've made a loss, or not being clear in terms of what's happened there. And we also then say, when we're talking about things that we report to by exception, we talk about the fact that there's nothing to report on whether they have failed to comply with the requirements of the regulations. So where we have strategic reports that don't tick all of the boxes, that don't have the information in them that they're required to have, we still have a responsibility to think about that and think about the impact on the financial statements, and where necessary, to think about the impact that it's going to have on our audit report. Please excuse me, I'm going to take a stretch for a second. To get rid of my particularly throat. Okay. I want then to say to you that you're all accountants. Well, some of you are lawyers, I think. But by and large, you're going to be people who are comfortable with financial information. So where I'm, for example, looking at a set of accounts, when I'm given one to review, the first thing that I do is to look at the profit and loss account balance sheet. And that gives me a feel for what it is I'm looking at, what types of assets they've got, how much money they've made, all of those sorts of things, because I'm comfortable with figures. So That gives me an instant picture of what my expectation is for that company. And then I'll go back and I'll look from the beginning and I'll read the strategic reports and so on. But I think that the issue that we have is that most of the people that are looking at financial statements aren't people that are comfortable with looking at all of that information. So very often what will happen with them, and again, this applies to charities in terms of their reports as well, if you deal with any of those, is that quite often people, they'll start it at the beginning, and if they get a clear enough picture for their mind of what they want to know about the company from reading the details, then whereas you might look at the profit and loss account and balance sheet and the notes to the accounts in more detail, what they'll do is they'll think, I've got the picture that I need from this, and I might just flick through the rest of the financial information, which is not so familiar with me and not so familiar to me, and not so user-friendly in terms of what it is that they're doing. So it's really important that we do actually take time to make sure that we're happy that the company has both covered all of the points that the regulations require them to cover, but also that what they're saying is worded in such a way that people can't go away with a picture that is dissimilar because to what they should, because quite often what people are going to want to do is they're going to want to look on the bright side in terms of what it is that they do. And it might be that the strategic report is actually giving a bit more of a positive angle that it should be made. I think that there's been a couple of reviews that have been done by the Financial Reporting Council, which then filter through in terms of the assessment that the professional bodies are making when they're looking at sets of accounts on QAD or monitoring visits, when they're looking at firms, where they're being critical, where the FRC has been critical, and they're taking those lessons through into looking at what's there within the accounts. And so I think that, you know, you thinking about it and thinking, oh, well, this isn't really my responsibility, you have to remember what those obligations are in terms of what's within the audit report and the impact that that's going to have in terms of what you might say or reflect with the client in terms of when you're looking at it. I think quite often they're poor because they're done at the last minute, and I think that that's, in some respects, that's reasonable, because I can understand that somebody would say, well, you know, we need to see what the final accounts look like. We need to know what adjustments are going to be suggested or made with them in order for us to be able to fill out some of the information that's there. But a lot of it is just strictly narrative information about what their performance has been and where their risks are and what their plans are for the future in terms of what's there. So they should be able to flesh it out a little bit. But I think that quite often it's not discussed early enough within the process. So my view would be that what you should be doing is that, you know, sort of if you're doing the audit, is that before you're getting started in terms of what you do on the audit, you should be sitting down and saying to them, of course, you know, we've got the financials here so far, but this is the other bit that you're responsible for in terms of putting the details of the strategic report together. And maybe, as well as giving them the framework in terms of what it looks like, you could give them an example of a couple of good ones that you can say, look, this is the type of thing that you might want to put in there, and just get the client to be working on it early enough in the process that it's not a case of it coming into you right at the very last minute. Sometimes I do hot reviews for people, so ones before the file has been sent off, and it's amazing how often when I see a set of accounts where the audit effectively has been finished, but they're still waiting for the strategic report, so they're not giving that, and it just makes you realise that they're not going to be looking at that in any great detail because it's going to be too rushed. Okay, so a little bit more on the detail. So the first one was saying with a fair review of the business and the description of the principal risks. The review that they put in should be a balanced and comprehensive analysis of the development and performance of the company's business during the financial year and the position of the company's business at the end of the year, consistent with the size and complexity of the business. So it needs to be a little bit more than just our turnover was, our profit was, our net assets are, in terms of what it is that they're doing. You need to put some context into that in terms of whether it's been a difficult year or a good year. You know, how the business has developed, how they're recovering, if it's relevant from the impact that COVID has had on the business, and you know how they're dealing with perhaps the situation within Ukraine and the and the pressures that increased inflation and energy costs are having in terms of the operation of the business. Those sorts of things we need to do. To the extent necessary for understanding of the development, performance or position of the company, it should have an analysis using financial key performance indicators, and where appropriate, analysis using other key performance indicators, including information relating to environmental matters and employee matters. For a medium size, so for a non-large company, so if it's medium size, the regulations say that they don't have to put in non-financial KPIs in. They can if they want to, but they don't have to think about non-financial KPIs. Whereas if it's a large company, they do need to think about whether they need to include the non-financial KPIs like staff turnover or whatever else it is that they're doing. One of the things that I see is that people quite often put in, the key financial performance indicators are gross profit, or, increased in the sales proportion, or whatever else it is. But they don't say anything in terms of what the target should be, and particularly in certain circumstances where where maybe there's been a major change in terms of what's there. They'll just have a comparative in to say, we measure gross profit and it was 20% last year and it's 15% this year, but they don't actually comment in terms of why that might be the case and the impact that that's going to have, and what they're doing to try and resolve it. Or has it been are they going for volume of sales and lower margins in terms of what it is that they're doing? So is it a strategic move in terms of it's not just a case of putting factually information into there, it's actually describing or putting some more commentary around that to make it useful to the reader of the financial statements. Okay. The strategic report itself has these 5 main content related objectives. So I think that bearing this in mind in terms of what it is that you're doing when you're producing them, it's worthwhile thinking about this. So the objectives are to provide insight into the entity's business model and its main strategy and objectives. So what it is that they're looking to do, how it is that they're working, to describe the principal risks the entity faces and how they might affect future prospects. So thinking about those bits that, we're going to have what we're going to have at the moment. You're going to have credit risk, maybe. There might be risks, other risks that are associated to Brexit, COVID, or the war in Ukraine. We might have, other financial risks, interest rate risks, our exposure, maybe foreign exchange risks, if we're doing, so currency risks. And so, we need to be not bland in terms of what it is that we're looking at, but saying to them, and maybe just saying to the client, what types of things do you watch out for? What worries you? Yeah. So is it if they're talking about inflation moving up above 10% again, is that what really triggers the anxiety for you and could have an impact in terms of what it is that you're doing for the business? So where are the risks? So you might even have, there's a lot of businesses at the moment that one of their biggest risks is availability of staff. That was across the board within the hospitality industry. If you look at it, when they started to open up post-COVID, a lot of them still couldn't open up completely because they couldn't get the staff to be able to allow them to open up completely. So, you know, that in itself is detrimental in terms of the way that they operate. So don't just go for the ones that are the obvious ones. Think about what it is for that particular industry, and think about the things that are the principal risks for the business, rather than, you know, we don't have to put stuff in. If they don't do any foreign transactions, you don't put in currency risk in terms of where it is. But, you know, they might have supply chain issues, anything in terms of what it is that they're doing. That it's to provide relevant non-financial and sustainability information. So to give people a little bit of a feel, you know, the financial statements are looking at the position in the past, but the strategic report has the ability to be able to give people some context in terms of where the business is going in the future. So it is a good way of them doing that. Providing an analysis of their past performance, and to provide information to enable the shareholders to assess how the directors have had regard to stakeholders and other matters when performing their duty under section 172. So, and that statement, you know, sort of, again, they can be quite bland in terms of the way that they do them, but the more information that they give around that, the better. Okay. Certain additional disclosures then. If you've got an entity, so it might still be a medium-sized entity, but if they've got more than 250 employees, then the director's report needs to have a mention of how employee involvement and engagement. So, you know, sort of a little bit more about how they operate and they engage their staff in the operations of the business. It should have the director's policy in relation to the entity's relationship with suppliers, customers and others, where it's a non-medium-sized company. So again, that, and we need to have the climate change and carbon emissions within there. So again, when the medium-sized limits have been breached, apart from with the employees, it's not just about being medium-sized, it's about over 250 employees for that engagement with companies. I should mention, in terms of what it is that we have here, that this information can go into the strategic report if they want to. But then if they put it into the strategic report, they need to have something in the director's report to say that those disclosures are actually within the strategic report rather than having them in the director's report. I think it's interesting. I don't think I've ever seen the climate change and carbon emissions in sets of accounts going in anything other than the strategic report. But it is within the legislation. It specifically states that that should go into the director's report. There is an element of me that wonders whether that means that over time that disclosure is going to be a requirement for smaller entities as well, so that they won't have to trigger into medium-sized before that information is actually required within the accounts. And I think that as it's bedding in, and the ability for people to be able to collect the information that they need around climate change and carbon emissions is a lot easier for them to do, then I think that there is a possibility that what will happen is that will actually come down into a requirement for companies that exceed the small company thresholds first, and then maybe some climate related disclosure into smaller companies as well over time. So, you know, that's just my own take in terms of what it is that they do here, that while we already have the strategic report in place, it seemed a little bit counterintuitive if they didn't have some plans like that for them to put it into the director's report rather than into the strategic report. Okay. Sorry, in terms of the next one, as well as the bits that we've already talked about, they introduced governance rules that apply to large companies. So a statement of corporate governance is required for individual companies now that have more than 2,000 employees so again, you know, sort of turnover of more than 200 million and a balance sheet total of more than 2 billion this year and last, or for the past 2 years. So a little bit like we've got for for any of the rest of them. So effectively, they need to disclose then the code that they use and so on. The Financial Reporting Council, if you look at any of the stuff that they do for audits, they seem to have a what makes a series that they've been following for a while. So so what makes a good audit, what makes this, and so what they've done this year is they've done one that says what makes a good annual report and accounts, and it's quite interesting in terms of sort of again, it's some of it is aimed or triggered towards really large companies, but it gives some good information that is just there and again is quite useful to pass on to companies when they're producing it themselves in terms of the types of things that you might want and expect them to do. So they have what they call the 4 C's of effective communication in terms of what they've got here, and that is that company specific, clear, concise and understandable, clutter-free and relevant, and comparable. So we'll go through those in a little bit more detail, but I think that they're just these basic rules that they say, look, this is what you should be applying and what you should be encouraging your clients to do in terms of what it is that they're doing, and why it's not a good idea for you to have the boilerplate ones. So the company specific ones, they're saying, that high quality are tailored, annual reports and accounts are tailored to the company. So not generic or boilerplate. And that one's really difficult because, again, if you're using any proprietary software to actually produce the sets of accounts, then what they're going to do is they're going to populate things with generic wording. So you could argue that this, because it's talking about the annual report and the accounts, it's talking about also the way that the narrative goes within your accounting policies and so on, to make sure that your start point might be to look at what a generic accounting policy would look like, but what you need to do is you need to tweak that to make sure that it's relevant to what's applicable to the particular client that you're dealing with, so that you don't fill it up with a lot of stuff that is surplus to requirements, or that you don't have things that actually reflect exactly what it is that they're doing. So not generic or boilerplate. So they include insights into the board's decision making, explain the company's business model in jargon-free language, and offer company-specific accounting policies. So there'd be the rules that you need to really think about. Are we happy that this is what it does? And again, I get the argument coming through from people sometimes to say that it's really difficult for them to be able to tailor some of that generic wording that's put in. But sort of, I think it is very important, because that's part of the way that you make sure that the picture that's being shown is actually appropriate for the business that you're doing. That they should be clear, concise, and understandable. So communicate information efficiently using straightforward language and short sentences. So that look at them, it should be aimed at the Sun reader rather than the Times reader in terms of what it is you're doing, that it should be understandable, and that people normally can pick that up in the short bites. That just makes it a little bit more user friendly, and the big drive towards all of the plain English stuff in terms of what it is that we do. They should be clutter free and relevant. So again, only relevant information is included in a good quality set of reports. Duplication should be avoided as far as you possibly can. Instead, cross references to relevant information is much more useful in terms of what it is that you're doing. Yeah, sorry, I think it's worthwhile just saying this because it kind of fits into what's here. Somebody said, Raza has actually asked the question, some companies only want to disclose the absolute minimum required so as to not inform potential competition of the business model, plans, etc. Is there a delicate balance to be drawn to comply with the requirements but not to wax lyrical? And I think that is right. It is right in terms of what it is that you do, but there isn't an excuse that says there's no concession within the rules that says you don't need to put this in because it could be detrimental to your your competition, or it could provide more information for your competition. And when we come on a little bit later on to look at the changes that are coming about in terms of company disclosure and so on. I think that some of these things are just going to go out the window completely in terms of what it is that you've got there. So I don't think you wouldn't put in anything that was, if you had something that was a plan for the future that was going to be quite innovative and you know, and you wouldn't want to give somebody, it would give somebody else a competitive advantage if they knew what your plans were in advance, then I think you wouldn't want to beef them out. But you can put something in terms of how you actually manage the business. So, you know, sort of like how you review the strategy and decide on, you know, sort of your plans going forward into the future. So you can give people some useful information generally about the way that the business is operating without giving away too much that could be specifically useful to your competitors. So that one, the first comparable bit, that they should be comparable to company information published in previous years. So you should be looking at them as being an evolving exercise and looking at what it is that you've put within the previous years and think about how it actually fits in with what you've got going forward. And you should be looking at the ARAs of peers. So, you know, sort of in terms of the competition, you should be having a look at those and seeing what they're putting in or what sector practices and policies, as well as information disclosed by peer group companies, should be considered when assessing comparability. So you should be looking at what the industry standards say. If there's a governing body or somebody that is that they're looking at that will say, you know, these are the types of things. And when it comes to the KPIs and so on, you should be looking at those in comparison to what you'd expect for industry standards, so that you can comment on whether you're doing better or worse than what they're doing. So, you know, but I know what people are saying, but bear it in mind that, you know, sort of this is an area that could lead you to be criticised if you've been involved in the preparation of them and they don't really say much in terms of the way that the business is operating. They say within it that the information should be material and relevant. So things that aren't significant, it's a little checklist afterwards that I'll show you, which is quite good. If materiality is disclosed in the audit report, then what they're saying in terms of here is that it's likely that the user is going to assume that that's the level to be used. So when you're thinking about whether something is material and relevant, you'd look at what it is that you've got them where you've got them there. Information is likely to be relevant if it has a predictive value, has confirmatory value, or provides information in respect to the organisation's ability to create or lose value. So that's what they're saying, just in general terms. That's what it is that you'd expect. And information is also material if omitting it or misstating it could influence the decisions and assessments of the ARA users, so the people that are actually going to be reading the financial statements. And I think that that is then reflecting the fact that even where there is a quantitative value put onto material within the accounts, then if there's information that you're looking at it and you're thinking, if I was a user of these financial statements, that would impact what my assessment was for this particular business, then, you know, so that could even be stuff about modern slavery and other bits and pieces that don't necessarily have that direct financial impact, but would be significant to the users. There is this little flowchart that came through from what they had, which I thought was quite good. So, you know, they're saying you should ask yourself the question, is a disclosure required by law or regulation irrespective of materiality? If the answer to that's yes, you got to. If it's no, then you go on to the next one. Is the item quantitatively material? So is it financially material? If the answer is yes, you disclose. If it's no, you go to the next one. Does the item have characteristics which may suggest it is qualitatively material? So do you think when you're looking at it, you're standing back and thinking about the average user and saying, would this be significant to them? Then if the answer to that is no, then you'd omit it. If it's yes, you go down to the other one and say, does the significance of the item's qualitative characteristics mean it is likely to influence ARA users. So the users of financial statements, again, if the answer is yes, you disclose. If the answer is no, then omit. And I think that sometimes, especially if you're the one, well, either if you're making the decisions or if you're helping them to prepare it and you're signing off an audit report, then having this as a sort of decision tree that you'd go through to justify if somebody ever comes back and say, well, why wasn't that disclosed? Then you can go through and do the justification in terms of what it is that you're doing there. Then the final one in terms of this little bit, looking at it, that the corporate reporting principles, the overall principles are that what you've got within there should be accurate, it should be connected and consistent. So you'd group information of a similar nature, it should be complete. And the complete side of it is that they're saying you need to make sure that you look at both the positive and the negative. So, you know, sort of you show a balance in terms of what's there. It should be on time, unbiased, navigable and transparent, which possibly you'd say are covered by the ones that we've got above there. Just before we take our second short break, I've had a couple of other questions that are in here that I think it's worthwhile. So somebody has said that Tracy, what's the relevant disclosure legislation to quote to cover non-disclosure of sensitivity or proprietary information? I think in terms of what's there, I can't give you a specific reference in terms of what's there. If you could put that one in later for me, sorry, if you could, if we could park it, then what I'll do is I'll send you an email with the full details in terms of what it is that you've got there. But as I say, I think that, you know, generally speaking, the client has to themselves decide, but they can't just globally go about saying, no, we're not going to say anything about this because we don't want to give people's plans away. They can word stuff in such a way that they're not giving away things that could be could be a real issue for them, future plans that they've got that are sensitive at the moment. Then they don't need to say specifically about any of those, you know, but they do need to look at it in general terms and the types of things. And a lot of them will want to put stuff onto the public record anyway, if they're down the line of plans to open more branches, to shut branches, to go more online and so on. Then I think those sorts of things, but maybe a specific product that they're developing, they might be able to say, well, look, we don't want to say anything about this at the moment because that would be giving away information that we don't want to give to our competitors. Okay, brilliant. It is 10:59, so if we could go for a break again for another 10 minutes to 11:09, which hopefully gives you time to get yourself a cup of tea or coffee, go to the loo and not have time to be too distracted by emails and telephone conversations. See you in a bit. Okay, welcome back, everybody. No more questions came up during the break time, so I'm just going to go on now to look at the common issues to date. So these are just some of the things that are coming out from the regulatory visits that people have, and from some of the reports that come through to the FRC in terms of stuff that we've where they believe that the accounts fall short of what their expectations might be. So the first one on there, it would have been wrong for me not to put this on here. We've already talked about it, so I don't need to go into it any further. But strategic report and other narrative reporting is coming up consistently from regulators doing their reviews and from the stuff that's been done by the FRC. There's been another thematic review in terms of their reviews of specific parts of financial reporting on cash flow statements, and within there again, you know, so that's mean that's been more of a focus in terms of looking at the cash flow statements, and the issue there is in terms of quite often misclassification or sometimes a lack of explanation in terms of the additional notes that go to the cash flow statements. So, you know, just making sure that where they've got loans, particularly where there's some shareholder loans or director loans that have come in into the company that they've actually been treated correctly within the cash flow statement. Judgments and estimates. Now, this is a sort of like another one of those ones that I feel quite strongly about in terms of what it is that you do. We talked in terms of the narrative reporting and what the FRC had said about that, but also in terms of them saying that, it extends through to making sure that those rules are complied with for the accounting policies. I think that we know that the accounting policies are the way that you interpret for an individual company what the you interpret how estimates and so on are actually dealt with during the preparation of the accounts. And I think it's really important that we make sure that we do have properly descriptive notes, and in particular where there are areas where there are key judgments and estimates. So that goes beyond the just being, sort of bad debt provisions, stock provisions, if they're doing revaluations. It's all of those sorts of things that you need to be thinking about, and thinking about whether you're happy that firstly, they have highlighted that these are areas where we are making judgments. And secondly, that the accounting policies do reflect properly how those have been applied. So they put them into context in terms of what it is that they're doing. I hope that makes some sense to you in terms of what it is. If I put that into context for me, in terms of all of the people that are attending this course, if what I did was I sort of miraculously managed to give to each one of you the equivalent of the old brown paper bag that's full of a lot of financial information and the like for a business, and I asked you to produce for me a set of accounts that showed a true and fair view from the information that I'd given. But what I hadn't done was I hadn't given you things like what the depreciation policies was going to be, even what my capitalization policy was going to be for the level at which I decided to put something into a particular category. If I'd given you an age stock list and an age debtors list, but I hadn't told you how I'd calculated what the provisions were. So I hadn't said to you, well, I'd make this as a standard provision. I'd just given you the age listing. If I'd given you all of the details of my insurance policies that have been paid and other things that are standing payments that measure over time, but I hadn't told you, I told you what had been paid, but I hadn't told you in terms of what policy I might have in terms of where it would be, how much should be accrued or how much should be prepaid in terms of the things that are there. If I'd have given you details of work that I was doing, but I was letting you make the decision in terms of at what point income should be recognised. So what within my work in progress should actually be recognised as being income. If I gave you all of that information and I gave you lots of areas where you needed to make judgments in terms of what it was that you were doing, then, but I told you that you needed to make those judgments, then if you're working for the same firm, you might come up with something that's quite close because you've probably got some fairly standard ideas and standard policies in terms of the way that you treat things. But if you're not, then I would have as many different sets of accounts, as many different sets of results as I've got people on the course. So, sort of, you'd know that would be. And the more places that I gave you of issues where you needed to make judgments or you could make judgments, the more of those that I gave you, the greater the likelihood that there would be a material difference between the one that was the most prudent and the one that was the least prudent in terms of what it was that you were doing. But they would still show true and fair view because you'd made judgments based on what your view was in terms of the way that things were being put together. So the judgments and estimates and the accounting policies are really, really important because what they do is they give the reader guidance to allow them to be able to look and to say, okay, right now this, where it's something that's significant, then if I'm looking at two businesses that I think are comparable, I can look at the areas of judgments and estimates. I can look at the accounting policies to see where there might be differences just because of interpretation and the way that something's been treated, as opposed to real true differences in the performance of the business, if that makes sense to you. So I think the judgments and estimates side of things, just remembering that it shouldn't just be a generic bit, neither should the neither should the accounting policies, but we'll talk about that one in a second. But you need to make sure that you're looking and you're thinking in terms of that reporting. Where is it that they do make those significant judgments and estimates? And often when you see it, things have been missed out. Things have been put in. People always put depreciation in, but very often it's not material. Whereas they might forget to put in about the revaluation or the fair value assessment of certain assets and liabilities within the accounts, which is likely to be more significant in terms of the issues. The next one is about consideration of impairment of assets. So, remembering that there are triggers that could result in you needing to make sure that you did an impairment. Most of the accounting policies will say that you look at whether those conditions apply and you'll do an impairment review if you need to, but very often they're not done. So you need to be sure that you're happy that where there's a possibility, where there's circumstances, like in terms of the business circumstances, in terms of the market conditions that could result in you needing to put an impairment through, that you do actually do a review of that. And I can add into there a little bit in terms of the revaluation side as well, remembering that very often within businesses, if they're applying a revaluation policy, that revaluation policy is more likely to be applied to increases than it is to decreases in terms of the value. So if you've got ones where they are doing the revaluation, but market conditions are suggesting that for that particular industry sector or whatever, that the values are deteriorating, then you need to make sure that if there's a material movement, that is reflected within the accounts. It's not a case of saying, oh, well, we're happy that it's going to have recovered this within the next 12 to 18 months or whatever else it is. You need to be looking and saying this is what it's going to be at the time. So impairment of assets, really important one. Provisions and contingencies. So making sure that you're happy that where you've got those, that you're happy that the conditions are met. And remember that we talked a little bit earlier on when we were talking about the update to FRS 102 in terms of some of the definitions that you've got there. But for a provision to apply, then it needs to be or to be relevant, it needs to be in respect of a past event, where you can reasonably assess what the financial outcome is going to be, and there is a likelihood that it's going to happen. So those three conditions have to be met in order for it to be a provision. But in certain circumstances, if you've got one or two of those conditions that would make, then you might have a contingency. So if you know that something, if there's a legal case that's going on, for example, and you know that there's going to be, you don't know what the outcome is going to be of that legal case, but it's actually happened, it's around an event that happened in the preceding year or in a previous year, so it's relevant in terms of the financial impact that you've got within the accounts this time, then you would, if you can't determine what the outcome is likely to be or the financial impact of it, then it would still, if it was significant to the accounts, be something that would need to be disclosed as a contingency within the notes to the accounts. If I give you a little example in terms of some of the things that you might have, so if you have you're producing a set of accounts where there is potential, or where they've got a debtor from somebody that owes them, say, £30,000 at the end of the year, and they go bust after the year end, then that's a contingency. It's your bad debt provision in terms of what it is that you're doing. If you know after the year end that £30,000 is not going to be recovered, then you would make a provision for it within the accounts. And if it was material to the accounts, you might consider putting a note to the accounts in terms of what it is that's happened. If, however, you had £30,000 that was outstanding at the end of the year, and for whatever reason you continue to do some work post year end, and a further £20,000 worth of goods or services have been provided, which were now not going to be paid, then you would still make the provision for the £30,000, but you couldn't make a provision for the £20,000 because that doesn't relate to the year that the accounts are being produced for. But if it was significant to the company, then you might disclose that as a post-balance sheet event, a non-adjusting post-balance sheet event within the accounts. And people get themselves a little bit confused in terms of the makeup of all of those things, but just look at it and say, does that 3-point check work in order for us to consider whether a full provision is needed? If a full provision isn't needed, then are there aspects of that mean that that we need to put in a contingency? So we put something in there to say, look, this event has happened, but we can't but we don't know what the overall outcome is going to be, so we're just giving some information. And if it's an event that is significant, that has happened but only happens after the year end and just is specific to after the year end, then you just think about whether that actually would have an impact on the readers of the financial statements, and so therefore does it need to be disclosed within the accounts. Little bit of a note in terms of here, in terms of a liability, we actually the benchmark for the point at which it should be recognised is a lower benchmark than it is for income. So we are very prudent in terms of what it is that we do. So as soon as there's a reasonable expectation that there's going to be a provision needed, then we would need to make that provision. That's prudence. But if it was a positive impact, in order for us to recognise income, there has to be virtual certainty in order for us to recognise income. So we could still disclose it within the notes to the accounts, but we might not be able to recognise it. So for example, if you had something that was insured, so if you had an issue that happened where there was insurance again about it, but you knew that you had the insurance, but you until you were actually making a claim, which you haven't been able to make at the moment because of the issues around, you didn't have full certainty about what the provision was, then you would still potentially need to accrue for something as a provision, but you would only disclose that you would hoping that it would be covered by insurance. You wouldn't be able to recognise the potential income until there was virtual certainty. Okay, a few other ones in terms of the common issues. First one is about accounting policies, which I've sort of probably almost talked about enough in terms of what it is that we're doing, sort of making sure that you've done them. But in specifically, these 4 that are ones that people tend to get criticised for. So firstly, for revenue, and that perhaps leads through to what we were talking about earlier on about the revenue recognition criteria that we've got coming through within FRS 102. But I think that what the regulators would say is that in a lot of circumstances, you need to have more in terms of your revenue recognition policy than just that sales are stated net of VAT, or something along those lines. That might be applicable to a small proportion of businesses, but where there are particular triggers, sort of like at what point do we recognise them, then that's important in terms of what it is that you do. On the stock policy, just remembering it's not just about talking about lower of cost and net realisable value, and maybe talking about what goes into cost. It's about remembering that stock itself, the cost for stock can itself be an accounting estimate, because we don't always do factually, what the value of the stock that we've got. So the cost of the stock that we've got. So if you're dealing with maybe like a car dealership, for example, then in terms of the cars that they've got in stock, they are going to be, because they'll have a relatively small number of them, and they will be applying the actual cost of that particular item in terms of what it is that they're doing. But for a lot of places, if you've got I don't know, shop, any type of shop in terms of what it is that they're doing, and they have stock lines that they operate, and they will sort of they will rotate them as much as possible, but so you can't guarantee which items it is that you've got within stock, the specific items that you've got within stock. Then what they'll do is they'll actually apply some form of estimation to determining what the stock value is going to be. So that might be first in, first out. It might be your weighted average cost or other form of average cost or whatever. And so your stock accounting policy should say how it is that they determine what the stock is. So is it done on a first in, first out basis? Is it done on an average cost basis, so that that's clear to the users of the financial statements? On the financial instruments, I think the biggest issue within this one is that people very often have disclosure around financial instruments that aren't relevant to the client. So where you've got a client that only has basic financial instruments, you don't need to put things in about derivative and interest rate swaps and various other bits and pieces which aren't relevant to the client or relevant to the business. So just remember, in terms of those, the accounting policies should be ones that are relevant and material to the entity in hand. And on the fixed assets, you know, big things in terms of these ones, I think that you have. One of the first ones is the tendency for people to talk about land and buildings being depreciated over 50 years or whatever it is. And of course, we don't depreciate land. So you should never include that in terms of what it is that you're doing, or you should have a specific comment to say that land is not depreciated. That most of the policies talk about you depreciating the cost or valuation less the estimated residual value, the standard ones, over the useful life of the asset, which is what you should be doing. And yet very often people don't recognize the residual value, which for some things are not going to be material because they'll just be scrapped at the end of it. But for in other circumstances, for property, sometimes for cars, you could potentially have material residual values. And so, you know, sort of there needs to be a consideration when the policy says that that's what you do, of how you deal with that. The next one, I've put in about deferred tax assets, but maybe I should put in about deferred tax as well. So remember now, although we didn't get what the freezing of the corporation tax rates, we are still going to have the increase in corporation tax rates. But we need to remember that now that that has been substantially enacted, when we're looking at our deferred tax liabilities, that those deferred tax liabilities are going to relate to things that will crystallize in the future. And so whereas we may have been providing those at 19%, if the rate, if the company is big enough that they're going to be paying 25%, or if they're going to be paying within the margin between 19 and 25% for the you know, the marginal rate that they've got in the middle bit, then you need to make sure that that is reflected within your deferred tax provisions. You know, an increase from 19% to 25%, which effectively is an additional third liability on top of what it is that you've got already in a number of accounts, is going to be a material movement. And so, you know, sort of especially if you've got deferred tax on revaluations, for example, where they're more significant sums of money, then it is really important that you actually make sure that you're happy that that liability has been adjusted for the impact of the increasing rates of tax. And then on deferred tax assets, where often those relate to losses that are being carried forward, FRS 102 is, I think, a little bit more stringent than its predecessor in terms of looking at that, where again it's saying that you should only recognise deferred tax assets to the extent that either they can be offset against the liability that you've got, so they are offsettable in terms of the tax rules. So you could, you know, you could reduce the liability by an asset that could be offset against it, so it wouldn't crystallize, or to the extent that it is likely to be used in the foreseeable future. So if that's around losses, effectively what you've got to do is you've got to look at the performance of the business and consider whether it is likely that in the next year, 2 years, 3 years, whatever period it is that they're forecasting for, that they're going to be able to utilize those losses. And so you don't have the, if you've got 50 grand's worth of losses that are there, and you're predicting that you're going to be able to use 30,000 of those over the next 2 years, then you would recognize the 30,000. You can still disclose the 20,000, but just because you think that it's going to start to happen, unless you've got some certainty around it, then you wouldn't actually recognize it. Now, this has raised its ugly head again with what we've had post-COVID, because obviously in terms of what we've had post-COVID, we've had a period where perhaps businesses have underperformed in terms of what it is that their expectations are. and as a result of that, maybe you haven't been able to utilize to the extent that you were expecting those losses. And if that's the case, then you need to go back and revisit them. Sometimes it seems to me that people, once they put them in to the accounts, they don't want to reverse that out because it makes the position look worse in terms of what it is that they've got to the within the company. But of course, if they're significant, then you have to do that. You have to look at it, and you can't just keep carrying them forward when they're loss making, because that would be against the rules in terms of what it is that we've got within FRS 102. Okay. And post-balance sheet events, I think I've probably already talked about that enough when we talked about the contingency side. Okay. Before we go on to the company stuff, because this is a compliance, and so overall compliance, I did think it was probably worthwhile just mentioning a few things on the on AML, just because you may go on to your annual updates in terms of AML compliance and so on, but really important for people to remember and to see this as being a fringe, sort of a central part of what it is that they're doing. And we're finding more visits by regulators now in terms of looking at AML compliance within firms, and B, we're seeing more action being taken against firms because they have failed to comply fully with what their with what the requirements are of the money laundering regulations. So I don't apologise for having a little bit of a prompt in here in terms of what it is that they're doing. So some of the things that they're coming up with, the 10 most common compliance issues is what I put within here. The first one is the updating of customer due diligence. So making sure that, as well as doing your regular review on a risk basis, so doing your ongoing monitoring, so it's not just a case of doing stuff when you take on, that you have triggers, that you remember that if you're providing somebody with a new service, if there's changes to the office holders, if there's a new PEP or an SA, a suspicious activity report has been made, as well as any changes in names or addresses and so on, that those are triggers that would make sure that you then think about it, when you're notified of that you sort of think, okay, right, I need to go back and consider whether this has an impact, whether I need to get more information off of the client, and so on. The CDD on the new clients, that thinking about that as being a 3-stage process in terms of what it is that you do, that you have to do a risk assessment in terms of the individual and the business. So it's not just about getting ID and address verification, so that you do your risk assessment and you think about, sort of where it fits, whether it fits in with your firm-wide risk assessment, so within the profile that you'd expect within the practice, and you determine whether there's additional steps that you need to take, that you determine who you need to get identification for, and remember that that is both the business and the individuals associated with the business. So I think sometimes people have missed the fact that, if you're dealing with a partnership or a sole tradership or a company, it's not just about the shareholders and the directors. It is also about making sure that you're satisfied that it's a bona fide business in terms of what it is you're doing, which could be company's house details, it could be VAT registration, or sort of something along those lines. That you identify who the parties are that you need to be looking at, and that you verify them. So you verify anybody that has more than a 20% stake in the business, and then anybody who is who's involved in control of the business. Okay. So perhaps within that, it's sort of like I've mentioned it within here, but the risk assessing of clients, that firms are very often criticised for that people are quite good at knowing and going through the process of saying, well, which of these people do I need to get identification for, and getting appropriate photographic ID or credit reports or whatever it is that's being done, that they do that, but they don't actually think about the nature of the business and the nature of finance, whether it's a cash-based business, whether it's dealing within one of the more risky sectors, which might mean that you have to take additional steps in terms of the work that you're doing to satisfy yourself that everything is okay. The firm-wide risk assessment So all of you, hopefully by now that are working in practice, will have a firm-wide risk assessment. The idea behind that is that what you do is you look at your business, your practice yourself, and you think about the types of clients you've got, the types of services that you provide, the geographical spread that your clients have got, whether you run things like client bank accounts, and how you actually deliver your service. So is it face-to-face? Is it, sort of remotely? Is it a mixture of all of these things? And so that what you do in terms of that firm-wide risk assessment is you look at, in some respects, you come up with a risk assessment for you as a practice. So what is your normal client? And I think for most firms of accountants, where you're operating with largely owner-managed businesses that operate within a fairly tight geographical area of where it is that you work, that you meet them face-to-face, that if you run a client bank account, you only ever put tax rebates through the client bank account. So what you do is you'd say, generally speaking, we're a normal risk. So we don't tend to deal with very many or any high risk or enhanced risk clients. And so then what their expectation would be, that one of the first things that you do when you're risk assessing a client is to say, does this client fit into the profile of what would be a normal client for us? So are they a normal client for us? And if they aren't, then is there anything particular else that we need to do, including, do we not want to take them on as a client? Sort of, are they too risky for us? So, sort of just remembering that. So the firm-wide risk assessment. So criticisms, you don't have one. You don't consider all of the risks. So you don't think about the ones that are outside of the norm. So the fact that you do have one or two PEPs, or you do have people that that are resident in countries other than the UK and so on. You do have some clients that you don't meet face-to-face. So you sort of you do all of those bits. And I think that probably I should add to that, that they see the firm-wide risk assessment as well as the policies as being something that is evolving. And so as a result of that, that you should be updating it as and when it needs to do so. Okay. Next one there, reporting discrepancies in the PSC register. So this initially started off as being something you had to do on take on. So in 2017, it came in to say that you should be looking at what your understanding is of the business, and then you should be checking to make sure that you're happy that that is consistent with what's on the PSC register. And if necessary, encouraging the clients, or, sometimes they'll be asking you to actually put that right so that PSC register is actually correct. Last year, so in October last year, that was actually extended to be an ongoing responsibility as well. So if you're aware of changes to ownership and all the rest of the bits and pieces, then you need to make sure that you actually do update that. Making sure that you do an annual review of policies, controls and procedures, so that you're not just saying this is what we do, that you're checking to make sure that you are doing what you say that you're doing, that you've done adequate training for the staff, and so on and so forth in terms of what it is that you've got. That a lack of written procedures covering your policies and procedures in terms of what it is that you do, so that people are aware of who the money laundering reporting officer is, who they need to make reports to, how they make reports and so on. That there's a lack of training, and in particular, at the moment, staffing is a real issue within a lot of firms of accountants. So there's been a lot more turnover of staff than we've seen for a long time within the profession. And of course, even if somebody has come to you from another firm of accountants, and so they should have a fair idea, if they've got a couple of years worth of experience under their belt, of what money laundering is, you still need to make sure that you've done some briefings, some checks, and where necessary, you've given them appropriate training so that they know what it is that they're supposed to do. This should be DBS. I don't know, I had a bit of a mind blow when I was doing that. I think CRB was a long time ago. So the data barring service checks on the booms, beneficial owners, officers or managers. So the key people around money laundering have to be approved by your regulatory body. But also you need to make sure that you have the DBS check for them to confirm, not just by self-assessment, that they don't have any any criminal records. And then the final one on here, no AML supervisor. So making sure that you're very clear on who it is. If you're registered with one of the main professional bodies, it's probably going to be with them, but some of them don't have authorization, so you might have to be registered with HMRC or you know, sort of, or so on. So just make sure that you're happy, that you know where it is. A couple of little triggers in terms of these as well, just to be topical things. You know, think about COVID support. It's still relevant. You know, you're probably still doing some accounts where they might be getting some coronavirus job retention scheme money or other grant income that's been coming through from the government as a result of it. You know, just make sure that you're happy that there is no fraud related in respect of the COVID support that's been given. The Institute, when they did this, said that they've found 40% where there was issues of fraud in respect of COVID support. So that's one. Somebody just asked a question, Delphina's asked a question to say, how often would you renew the DBS? At the moment, they don't tell you that you need to renew them. I think that their view would perhaps be with the DBSs is that once you've got them in once, you can prove to the institute or the association or whoever your regulator is that that person is a fit and proper individual, and then you'd go through the normal regime that you do of asking people to do the self-declaration, and that you should be aware if, you know, sort of like anything onerous happens in terms of that time. So until and if they give some more guidance, I'd say that once you've got it, you can just stick with it in terms of what you do. But of course, you know, any of you that deal with schools or care homes, and you might visit them, so you might go within the premises of somewhere where they've got children or vulnerable adults, might want to keep DBSs on have a broader scope of them, to be honest, so that, you know, sort of you can ensure that you're not allowing somebody into where they could be putting people at risk in terms of what it is you're doing. Okay, so the COVID support, just watch out for that one, and remember that, you know, sort of in order for it to be a crime, there has to be intent. But you know, if you think that there was enough publicity around what was going on, that, you know, sort of it would be very hard for somebody to say, oh, I didn't realize that somebody couldn't carry on working full time and while I was claiming for the COVID related support. Okay, and again, just a reminder here about sanctions screening. So, you know, again, we've probably all seen a lot in the press in terms of sanctions that have come about as a result of what's been going on in Russia and Ukraine. If you use electronic verification, then very often they will keep you up to date if people newly become on the sanctions list or the PEPs. But if you've got risky clients, so people, you shouldn't just do it on take on in terms of what it is that you do. You should make sure that you that you actually that you check them as part of your ongoing monitoring, or that you subscribe to. You can subscribe to the OFSI's newsletter, and so what they'll do is they just send you through a prompt to tell you when there's been a change in any of the sanctions lists. So if you've got clients that, you know, sort of have got Russian connections or whatever else, that you can actually check them on a regular basis. Around the start of the Ukrainian stuff, you were getting probably 3 or 4 of those a day. Now it's more likely to be 1 a week, so it's not really onerous in terms of what it is that you do if you subscribe. Okay, and then in the last few minutes, my other issues that I wanted to talk to you about were just about companies reform. So I think somebody asked a question about this before I was doing the course, and I was pleased that I actually had it in. We don't at the moment know what the implementation date is going to be. They haven't announced it. We know that it's going to happen. There's a lot, if you look around the stuff on the government, so it's not, you know, sort of, it's gone beyond it being just something that is out for consultation in terms of what it is that they're doing, but they haven't stipulated what the start date is going to be. I suppose you could say that it might be something that would, that if we get a change of party in government and it hasn't come into full-blown legislation before then, that it might be something that is relaxed. But it strikes me that probably if you look at some of these things, they're more the types of things that you might have expected a Labour government to put in rather than a Conservative government. So it seems that it would be unlikely that they wouldn't do it. I had thought that it might coincide with making tax digital. In terms of some of the things that are in here, it would make it reasonable for it to be consistent with what we've got for MTD. But on the basis that that has now been deferred, whether that puts this back or whether they will still go within whatever timetable it was, but just to put you on warning. So major things that we've got within here: new obligation to verify the identities of new and existing directors, and a similar ID verification regime for new and existing persons with significant control. So Companies House are going to be able to do that. And so, you know, they will be looking probably for more information around individuals before they go on. There's going to be a new obligation for authorised corporate service providers. So people like yourselves, professional advisors and agents that form and administer companies for clients, those will need to be registered with Companies House before they can file information there. So that's going to be a new process going through, I suppose, similar to the 64.8 situation that we've had with HMRC for a long time. There's going to be some restriction on the use of corporate directors, including a ban on foreign corporate directors. So again, not fully clear exactly what that's going to be, apart from the ban on foreign corporate directors. But I think that it will be that you can't only have a corporate director. So you have to have somebody who's in inverted commas, a real person in terms of the people that are there. Some restrictions on who can be an individual director. So, you know, again, around fitness and propriety and so on in terms of what they are. There will be more detailed shareholder information to be filed. So I think that one's quite interesting, because when we move from the old style annual return to the PSC, we reduced the amount of information that was on the record about the actual number, and we're just putting things in ranges. So I think we'll just have a bit more information now. The biggie here, sort of like hidden in the detail: abolition of the rules allowing small companies and micro entities to file abridged and filleted accounts. So people searching at Companies House will see the same accounts as members. So real biggie here. So basically what that means is that the full accounts, which won't be able to be abridged for small companies, and the full accounts for micro entities, including the profit and loss account, including the director's report for small companies, will have to be filed at Companies House. So all of that information will be there. And if you remember, any of you that can remember, when we used to have abbreviated accounts, at one stage, we used to have abbreviated accounts for medium-sized companies as well as for small companies. And within the abbreviated accounts for medium-sized companies, there was the ability for you to be able to start the profit and loss account at gross profit. So that was to allow information not to be passed on. But if you read the information that they've got on Companies House when they're, or, you know, on the government's website, when they're actually talking about these reforms, one of the things that they're saying within there in terms of what it is that they're looking to do is that they feel some of it is about all the money laundering stuff and all the rest of it, but some of it is also about transparency for the users of the financial statements. So for including financial institutions, the credit brokers, and all the rest of the bits and pieces. I have to say that it's something that I find uncomfortable in terms of what's there. We used to hear people talking about this within, you know, sort of years and years ago, that they would be quite sensitive about putting information onto Companies House, so they do their abbreviated accounts and so on, because they didn't want their competitors to be able to search and see how it was that they were doing. And sometimes I'd be a bit cynical about it, because at that time you had to pay. So you had to pay a you know, sort of like a fee in order for you to do the company search. And so my view was that, you know, sort of, well, people have to be really, really interested in order for them to go to that amount of that amount of bother. But of course now we can get all of that information free just through doing a search. And, you know, sort of, I think that it will open up stuff and perhaps mean that we need to make some decisions. And I'm not a tax person, but, you know, sort of it might mean that that people want to look at the structure, the way that their business is operated. They might want to split it up into different companies so that it's not as clear a picture in just one in terms of what it is that they do. So we might have a bit more complication coming in terms of what it is that we're doing, but it's going to be a major issue. But as I said at the very beginning of it, we don't know. We know this is coming, but we don't know exactly when it's going to come in. I will say here, I mentioned to you around FRS 102 about micro entities, and I will push it again here, because even though micro entities as well as full-blown companies will still have to file their full accounts, firstly, the notes to the accounts, so the detail in terms of explaining some of the stuff is not as detailed for micro entities as it is for others. And secondly, the structure of the profit and loss account format is such that it doesn't give away as much obvious information as you get when you're looking at the a statutory P&L for a small company or for a non-small company. So I think that this should also provide you with the, if the clients are sensitive, provide you with the driver of thinking about, should we be thinking about micro entity accounts for some of these entities where they do qualify. There's a power that's been put in to enable Companies House to require information to be filed digitally, including the accounts. So that's the expectation, is that everything will have to be done digitally. There is going to be a new statement of eligibility to be given by directors of dormant companies before they can file dormant company accounts. So, you know, sort of they'll have to confirm that they believe that it is. There's a power to restrict a company from shortening its accounting reference period. So I'm sure that you have all, at some point, taken advantage of the fact when you've got a client that's going to be a little bit late in filing their accounts, that that if you, on the last day before they've got to file, change their accounting period by 1 day, you can still make it up to that year-end date. But by shortening their accounting period, you get an additional 3 months to file. Now, perhaps we've seen a little bit less of it recently, because I think Companies House has still been quite relaxed about allowing people an extension for illness. So for the COVID related stuff, that still hasn't gone. It's not an automatic extension, but it is almost automatic if you go in and you just takes it, you know, it's a 5-minute exercise to go through and request it, and it comes back normally on the nod without them asking any additional questions in terms of what they do. But sometime that one's going to go. So, you know, we just know, I haven't said exactly how they'll do it. So what they might do is they might put the same sort of level of restriction to shortening an accounting period as we get to lengthening it, which is without specific permission. You can only do it once every 5 years. So, you know, so we might get that in terms of what it is that we do, but we just have to be careful. Companies House is going to have a power to cross-check information filed with it against that held by other public and private bodies. So much more sharing of information, and they can reject or remove it from the public record unless supporting evidence is provided. So again, that they're going to be doing those sorts of cross-checks in terms of what it is that they're doing. There's a power to reject or remove information that appears suspicious, fraudulent, or might impact upon the integrity of the register. So, you know, wider ranging powers. There's going to be some new restrictions on company addresses in terms of what they can have, so that, you know, sort of they're perhaps looking to reduce the amount where there's almost theft, address theft. It's quite a common one for that accountants, if they allow themselves to be used as registered offices, that because they might have quite a few companies that are on the where they've got them on the register, that somebody will think, well, you know, if I want to have a registered office address that's in this country and I haven't got anywhere to put it, then I can just steal their address because they're unlikely to notice. So, just be careful about that one. Abolition of the need to keep most statutory registers, such as the Register of Directors and so on. I think because if they're starting to keep more information on Companies House, then it's almost like its own register in terms of what it is that they do. There's a new requirement to provide a company email address to Companies House, which won't be visible on the public register, but they need to have that. I think that one's quite interesting because I do have a company email, but most of the time I give people my BT Internet email as my email address. So I don't know what they do, whether you need to have the company name into the email address in order for you to be able to register it, but they'll have to look. There's some new restrictions coming in on the characters that can be used in company names and new powers to reject names that facilitate dishonesty or deception. So, we already know that we have that. You can't put chartered accountant or chartered certified accountant into your actual physical name, because that could be seen as being misleading. If somebody could register a name with that, they might not be one of those, but still be able to call themselves it. So they have those ones. An extension of the Companies House powers to suppress personal details filed. So, sort of for them to be able to keep those down. New power to impose automatic civil penalties for failure to comply with a wide range of Companies Act obligations. So we've already got those penalties that automatically come in for late filing of accounts, but perhaps a little bit more that will come through, and maybe even ones that will come personally onto the directors in terms of what it is that they're doing. And to make it consistent, there will be similar changes to limited liability partnerships as well, to actually bring them in line in terms of what it is that we're doing. So, I feel as though I end on a low in terms of doing this, but in terms of things to come out of where I think to come out of today, in terms of things that you need to do, I think you need to, firstly, you need to be looking at the clients that you deal with and considering whether they are using the most appropriate accounting basis for them. So think about the provision of FRS 105 or FRS 102.1a to start to collect the information around. So maybe to have like a little one-page checklist that you put onto each lots of accounts to ask about whether they've got any, what leases they've got, whether you've got a full record of them. Because if you're doing audits, then probably you do have that. But if you're just doing accounts preparation, you might not have those details, but they're going to be more relevant in terms of the accounting treatment going forward. So the earlier you start to collect the information, the easier it's going to be for you to comply. So start to do that. Start to look at what they're doing for their for income recognition, and make sure that you're happy at what the points will be, how it will fit into that 5-point plan in terms of what it is that they're doing. Keep on top of your AML stuff, so that you're so that you're making sure that you're doing all of the things that you need to do within that one, and prepare yourself for what's going to happen with the company's reform, and prepare your clients as well. So sort of like think about that in terms of the planning that you're doing for them, and what impact it's going to have for them as a business, and what they might want to think about doing at this stage to prepare themselves for it, rather than wait until we know it's coming in on this particular date and all of a sudden it becomes too late for you to be able to do too much if you want to do any sort of restructuring or other considerations. So almost exactly on the button of 12. That's all that I needed to say to you today. If you've got any questions, then I think we're going to keep it open for a couple of minutes if people want to put anything additional into the question and answer box. But my contact details are on the beginning of the slides if you want to have them, or you can contact me through the hub, the K3 hub, if you have any questions that you want to ask relating to issues that we've considered today. So thank you very much, and my profound apologies for the coughing and spluttering during the course of the session. I hope that didn't put you off too much. Thank you, Julie. Thank you, Jeanette.